Good afternoon and welcome to the IQGEO Group PLC preliminary results investor presentation. Throughout this recorded presentation, investors are being listen-only mode. Questions are encouraged, can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company review all questions submitted today and will publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Hayward Chapman, CFO, and Richard Petty, CEO. Good afternoon.
Good afternoon. Thank you very much, and a warm welcome to everyone here. My name is Richard Petty. I'm the CEO, and I'm here today with Hayward Chapman, who's our CFO. We've got a presentation that we think will cater for everyone here. So for those of you not familiar with the company, we've got a brief introduction of what we do and something about our markets, and then we'll take you through our results today. I think we'll have time for Q&A at the end as well. So Hayward, I'll ask you to advance the slide deck straight through to a company presentation. So let me start by telling you at the very highest level what IQGEO are. So we're a software company, and we help network operators build better networks. Specifically, we operate in the telecommunications and utilities verticals. So those are the only markets we do. And we provide a single solution to help these operators plan, build, and operate better, safer, and more efficient networks. So we're a relatively small company, but we are global. So we have presence in three main markets, North America, Europe, and Japan. Today, we count over 320 customers worldwide, approximately 75,000 users, across a wide range of segments. So we deal with very large tier one type customers right the way down to small and private network operators. So we offer a full service. About 150 staff and full-time contractors and partners around the world. All we do is geospatial for network operators. So it's quite a specific thing. But this does allow us to be competitive against some quite large companies worldwide. We're a proven team. Most of our employees have been in this market for many, many years. And we're very lucky to count probably world-class experts in our product management and product development and deployment areas. So that makes us, a force to be reckoned with. We sell worldwide. We sell much of what we do is direct, but in many of our markets, we do operate with partners, Japan in particular. And we have very strong partner relationships there that are allowing us to win very good business. And our product is sold as a subscription, and it is cloud enabled. So it typically gets deployed in the cloud, sometimes in a private cloud, sometimes in a public cloud. But from an architecture perspective, we are a very modern solution. I'll say a few words here about our product positioning, just to help you understand what we do in more detail and how we position ourselves against our competition. So we align our product to the what's called the network lifecycle. So these are all of those activities that an operator will undertake to build, design, and operate a network. So you can see here a series of circles, which basically are our modules. And you can see here that we have functionality available to our customers really at every stage of what they're doing, whether it's in early planning phases, which is the sales and marketing slide there, in deciding where to expand or improve a network, the whole planning and design phases of a network, the handover to construction and build out and subcontractor management, and then beyond that, maintaining a healthy network that is generating revenue and using all of that information either at the help desk or with new sales teams in the CRM. So what's unique about this is that we provide a single solution for all of this. So the market has been served by incumbents in the space for many years. And, the systems out there are aging. These are, in some instances, 30-plus-year-old systems that were not really designed for all of these activities. Typically, they sit in the planning and design circle, you can see there. which means that many customers have had to improvise and go and buy other solutions in each of these circles, and then shoulder the burden of having to keep them integrated and trying to manage the data gaps that inevitably appear with them. And what this results is in broken workflows and silos of data, making these companies really quite inefficient. And the reason this has all come to a head is because of the very significant investments that are going into this market. And Hayward, I'll ask you to go to those slides in just a second. But there are very big investments going into this market, no, sorry, Hayward, could you mind staying there? Very big investments going into these markets, which means there is a surge of work happening right now as telco networks upgrade their networks, roll out 5G, roll out fiber, or as utilities networks work towards zero carbon and work towards integrating low carbon energy sources. So this is, these once in a generation investments. These once in a generation investments are happening right now, and the systems out there really aren't able to cope with the work, and this creates a fantastic opportunity for us. I'm going to handle the first question. Where are we looking to target next? So we think there's a lot to do in our core markets right now. So Europe, Asia, Europe, Japan, and North America. There is a lot of runway to go in these markets already. And my philosophy is always, let's do one thing well before we expand into other markets. We are, starting to develop some channel relationships to take us into South America, Sub-Saharan Africa, Middle East, and places like that. But for now, there's plenty to do where we are today. Hayward, I will ask you to drop to the market slide, just so we can put some numbers. Yeah. So I'm going to spend a moment just talking about the underlying drivers in the market, because they are so important to what we do. So let's take, for example, the North American fiber penetration in the US. What's really interesting here is that you can see the red line here indicates that only about 40% of US homes have access to fiber broadband today. So that means 60% is yet to come, and operators have spotted this opportunity, and there are trillions of dollars being invested into broadband capabilities and 5G capabilities in the US market today. A lot of it is private, but there's also federal money going into this as well. The Biden government has approved $65 billion for expanding, in particular, rural broadband coverage. And today, everybody, all of us on this call, I think, understand the benefits of a good fiber broadband connection at home and at work. On the utility side, we see an ever strengthening regulatory environment, pushing, in particular, electricity operators towards net zero emissions. And this is forcing a complete rethink in terms of how energy is generated and distributed and consumed throughout the day. And these really significant changes to the market means that systems like ours are needed to model, design, and build out the networks of the future. So we see very significant long-term capex trends in both of these markets, which we are selling into. On the next slide, Hayward, and again, to address the point of Mark A, there are very substantial markets, opportunities to go after in North America, Europe, and Japan. We currently count our market at around 17,500 companies, and we think this is an addressable market worth over 1.2 billion pounds expressed as an annual spend. The telco market is smaller, but it is at 200 million a year, but it is faster moving and very active right now. And a more long-term market is the utilities market, but we can already see very interesting spend in that right now. So we see a very dynamic market with lots of runway for us, and a sustained market opportunity that we think will last many years to come, probably decades. I think, Hayward, why don't we go straight to some numbers? I think we can skip this slide.
Okay, I'll just go through the results overview for the year ended December 21. So just at a high level, we did £13.8 million worth of revenue, which is a 51% 51% increase on the level we did in 2020. Now, 3 million of that came from the OSPI acquisition that we acquired in December 2020. But underlying, our organic growth rate for sort of the enterprise level business was 18%, which it was, and it was 18% between 2019 and 2020. So a constant rate of organic growth, supplemented by the acquisition that we did. Gross profit was up by 85% to 8.8 million, up from 4.7 million pounds in 2020. Which was helped by the increase in the gross margin percentage, which was up by 12 percentage points from 52% to 64%. And that's predominantly due to the change in the sales mix. We sold more subscription revenues, which I'll come on to, and also the increase in perpetual licenses. And both our perpetual licenses and our subscription revenues and recurring revenue carry about a 90% gross margin. The result of that overall was that our adjusted EBITDA loss fell from 2.5 million to 0.8 million, so decreasing by 67%. And all of these results were marginally ahead of the forecast that we had in the market. So we're really pleased with that. Just a couple of other points. We've got good net retention as a company, so we have a strategy of land and expand. Once we get into a customer account, we find that they take either new modules or they increase the number of seats they've got. We sell on a per seat basis. So we had a net retention rate for recurring revenue of 113%. That's an average of the enterprise business and the SMB business. It's slightly higher in the enterprise business because it's larger, stickier. At the SMB level, it tends to be higher numbers of smaller accounts, get a little bit more churn, but still really good. Okay. Just looking a little bit more at our recurring revenue, we do focus on recurring revenue because that's the key driver to the growth of the business and the way we sell all of our products. Our exit ARR increased by 54% from 5.3 million to 8.2 million in the year. So, a couple of extra points there. The enterprise business increased the recurring revenue order intake increased from 1.4 million in 2020 to 2.3 million in 2021. And the SMB business, which is based on the OSPI business that we bought in December 20, that did 1.1 million pounds worth of new annual recurring revenue. And that's an increase from the year we bought them when they did 0.5 million. So we're sort of seeing that, they've done really well post-acquisition. That means that our in-year recurring revenues were up 80% from 3.2 million pounds in 2020 to 5.8 million pounds in 2021. And continuing on the theme of our recurring revenue order intake increased by 63% to 10.3 million pounds, up from 6.3 million pounds in 2020. In terms of cash on the balance sheet, we're still slightly cash flow. We're still burning through cash at an operating level, although the second half of the year was almost break even compared to the first half of the year. But we ended up with 11.5 million pounds, which is up from 10.5 million pounds in 2020. We received 2.5 million pounds from the sale of a legacy investment business that was sold back in 2018. That was received in January 2021. So again, helping our cash increase for the full year. Just in terms of some more KPIs, our own product orders, you'll see when we come on to the slightly more detailed analysis of the P&L, we have some third-party product services that we perform, although that is decreasing. But so we do focus on our own product orders, and that increased by 77% from 10.7 million pounds to 18.9 million pounds in 2021. And from that, our own product revenue increased by 75%. From 7.3 million pounds in 2020 to 12.9 million pounds. The number of new logos again, we're really pleased with that, 76 compared to 13 in 2020. On a like-for-like basis, the enterprise business new logos increased from 13 in 2020 to 22 in 2021. And the OSPI business, which of course we bought in December 20, they signed 54 logos in 2021. We haven't shown the comparatives in 2020, but I know that they signed, I think it was about 36 up to the year that we bought them. So again, both parts of the business going forward and making some really good some progress in terms of the new customers won. In terms of our employee headcount, up slightly to 102 as of December 2021. We have got a large recruitment program in place as we go into the first half of 2022, and we're looking to recruit up to 40 additional roles as we grow the business, not only to cope with the customer base that we've won, but also to help us increase the speed of growth as we go forwards. And then just the last slide on the summary financials. Just reiterating our income statement, our revenue up by 51% to 13.8 million, gross profit up by 85%, helped by that 12% increase in the gross margin to 64%, and operating expenses up, but slightly less by up by 25%, and all of that meaning that our adjusted EBITDA loss has decreased from 2.5 million to 0.8 million in the year. And as we go into 2022, we're expecting to be cash flow break even and adjusted EBITDA positive in 2022. Okay, I'm going to hand back to Richard just to go through some customer logos.
Yeah, actually, we could probably handle a couple of questions, Hayward, that have come in around the numbers. So we've got from Morgan and Ryan here. So one on profitability.
Shall I answer Morgan B?
Why don't you go for that?
Yeah. So you said, well done for the results. Do you expect the current trend in the bottom line to continue? Is it realistic to expect IQGEO to be profitable on a reported, not adjusted basis next year? Okay, well, I'll answer the first part of that. Yeah, we do expect the current trend to the bottom line to continue because we're building recurring revenues. We had 3.2 million pounds worth of annualized recurring revenue order intake or new recurring revenue in the year. Okay, we're increasing our costs, but not as much. So we're on a relatively fixed cost base. We're just building those revenues year on year, and as we recurring revenue, it repeats the following year. So yes, more of that will fall through to the bottom line. I expect it will be marginal whether we get to certainly at an adjusted EBITDA level we will be profitable next year, but I will have to I can't really say at a net level. And then the third part of that question, how will you maintain margins in the face of inflationary pressures and competition? I mean, I think in terms of the inflationary pressures, the majority of our costs are wage related, and yes, we are seeing inflationary pressure there, especially as we're trying to recruit. It is a very competitive market, but we have a really good product, and I think with the wins that we're going to be talking about very shortly, or Richard's going to be talking about very shortly, I think we're not necessarily a price taker in the market. We can almost to a certain extent we can set the prices, not completely, but we're certainly not having to go in cheap to win the customer because of the quality of the product. Yeah. What keeps me up at night? Not a lot. I'm a pretty sound sleeper, so nothing certainly from the company's performance. There's nothing really to worry about. I think it's sort of just maybe achieving the growth that we've set ourselves, growth targets we've set ourselves, and keeping trying to grow it as quickly as possible.
Where do you see gross margin in the future? Ryan has a question about that.
Well, I think from a good software company, we're looking to grow the company over the next 5 years to something that's got around 80% recurring revenue. That would be good. And I think with a sort of a good software company, you've got to be targeting, 40%, circa 40% EBITDA margins. So that's what we are over the next 5 years. That's what we're looking to achieve.
And just circling back on the question of inflation, most of our contracts allow us to apply inflation to the recurring fees that we have. That's built in, and we have that mechanism there to protect us against inflation. Good, thank you, Hayward. On new customers and expansions. So we signed 75 customers last year, so there's a lot to cover. But there's a few selected here on the enterprise side that I think are worth mentioning. So the most important, I would say, shift we've done with the business is to move towards systems of record. So if you can recall the slide I had earlier with the network lifecycle, it kind of moves from left to right on the diagram, from sort of design and planning up to operation. We started in operations and we've worked our way back to system of record. Now the reason we've done that is because we see that the system of record is in some ways more strategic to these customers, and therefore commands higher prices, and is really the crown jewel, if you will, of the geospatial stack. So that's where a lot of our R&D work has gone, and we're pleased to see that we've been winning some really impressive customers in both of our verticals. So the first is Portland General Electric. They're based out of Oregon. They're an electricity distributor, and there we were selected as their platform for their zero carbon electricity grid. So they are subject to some quite fierce state level regulation to decarbonize. They have to be carbon free by 2035. And so they needed to select a new system on which to plan and model this zero carbon strategy. They are a customer that use one of the legacy systems out there in the market by Esri, and they, after doing a market evaluation, decided not to do the next phase of their network on the Esri platform. They've decided to do that with us. So it's a very high-profile win for us, and they will be over the next 12 months or so implementing the product, and also helping sort of refine our roadmap. So we see this as a very important first step in the electricity market system of record. Over on the other side, Brightspeed is a very important telco win for us. So Hayward, would you go to the next slide? So Brightspeed is the product of a divestiture by a national operator, telco operator in the US called Lumen. Many of you that have traveled to the US will probably have heard of CenturyLink. Lumen is the rebranded CenturyLink. They bought up various other assets, including Dish, and called themselves Lumen. So they've decided to sell off half their business, and this is the states colored here in orange, about 20 states. And this has been picked up by a private equity called Apollo, and Apollo have brought in a team from Verizon to manage their new telco company. What's really interesting about Brightspeed, as they're now called, they decided not to go with the opportunity to use the Lumen systems. They've taken a clean sheet of paper and decided that this is an opportunity to put in the systems they want from day one. And so we've been selected as one of their 4 initial suppliers, and we are the system they will be doing all of their planning and design and construction management on. So, and I think this very much sets the tone of what, in many ways, the future of our business will look like. So here you are, a company selecting a system of record on, in a competitive process. They've already placed 2 orders with us. So they placed 1 order last year for a total of $4.5 million a year, and they've already extended that. So we have a total contract value there of $6 million. So 2 important things to point out. So this initial year of their contract running 2021 is kind of a stub year or a ramp up year, if you will. So in terms of value, the first, I would say, full year for us is 2023. And there we will be earning roughly, actually $1.3 million a year with this account. And this is for the initial 50 users. So these are just the key users, if you will, that will be doing much of the planning and decision making. And so, in addition to the $1.3 million we're earning there a year just in service fees and just in software fees, so the professional services are separate, as the software expands across the organization, and they have, like most tier 1 telcos, thousands of employees, there is a tremendous opportunity here to expand. Now, obviously, not all users will attract the same license fees. This is an initial setup, divided by the early users. But nevertheless, the opportunity is clear as we expand to, 5 or 10,000 users here, that, we will see significant increases in revenue. And this is the first of several of these opportunities that, we see. Technically, what we're doing here is quite complex. In the business, this is known as an overbuild. And what you've got here is Lumen taking really quite an old legacy copper network and pivoting it to a fiber, a premium broadband, fiber broadband product. For them, it's existential. If they do not convert this customer base, they will lose it. Nobody today is happy with a copper wire service. They're painfully aware of that. So there is a race against the clock for Brightspeed to upgrade these customers. By the way, Lumen have to do the same on their side of what they've retained, and so it is with many of the other national operators. Not only the ones who are running on copper, but also the ones that are running on HFC, which is to you and me is the old-fashioned TV cable. So these overbuild projects are complex. They're a race against time. From a system perspective, you have to ingest a lot of old data, and you have to incorporate that into your design algorithms so that you are producing the least cost design for upgrading these networks. So technically much more complex than a greenfield design. And so, winning this contract is a real testament to the quality of the product, the quality of the team we have behind it, and is a real flagship win for us. Not just in the US, but around the world. So we're extremely happy with that, with this win. This is probably a good juncture to address the early question there from Paul, who was asking about workforce productivity. Now, Paul, you phrased the question in a very particular way, which says, given headcount increases, is workforce productivity over time going to be tracked? Well, the first thing I will say is that in our industries, utilities and telco, headcount is not increasing. And this is really at the root of why we're doing well. So if you observe employment in telecommunications and in utilities, it's coming down. So over the last 10 years, in North America, for example, employment in these markets specifically in field engineering has come down around 7% over the last 10 years. It's not an attractive employment opportunity. People are not rushing to become line workers. And so the challenge these companies face actually is, in the face of declining employment, how do they increase productivity? And so that's where tools like us come in. So, we are replacing many old processes based on paper and clipboards and Excel spreadsheets and very primitive digitization. And we're replacing all of that with a single pane of glass to the business, and integrated workflows that connect many departments. And so all of this is to reduce the amount of time in the field people spend looking for things and calling head office and returning to base and collecting the right tools and collecting the right equipment. So with good information and good digitization, you're actually dramatically increasing the productivity of these people, which then gets measured. Different companies measure different ways, but typically it's the number of jobs they're doing or the number of fixes they're doing in a day. And there are very clear metrics which demonstrate that when you install systems like ours, productivity goes up. Generally the way that is taken is not so much in reducing workforces further, because they have trouble recruiting. So it's really about doing more work, and at best reducing the use of subcontractors. So you can build more and faster, you can fix more and faster, with a system like IQGEO, in your geospatial stack. So thank you for that question.
Okay, I'll just go through a little bit more on the detailed financials, and I was actually going to answer part of that question, because I think it was Mark A who asked it. It was more, I took it as being more focused around, are we going to be tracking, as we increase our headcount, are we going to be tracking increasing, KPIs such as revenue and EBITDA per head? So I was going to answer that as part of this, which is a summary of our overall revenue and how we break it down. So you can see our recurring revenues have increased by 80% to 5.8 million. So they account now for 42% of our total revenue in 2021, up from 35% in the prior year. Our perpetual software, I mean, this continues to be lumpy. Last year we only did 0.3 million. This year we've done £2 million worth of perpetual license software, and this is because in the timing of deals, and some of our customers still take perpetual, or still want to take perpetual software. Predominantly in North America, in the utility markets, they're not able to pass on OPEX to their customers, so they prefer to therefore buy perpetual licenses rather than subscription software. But it varies from customer to customer. Services, we've had a really good year in terms of services, and we've had more customers, and that's increased by, our services revenue has increased by 32% from 3.8 million to 5.1 million. This is predominantly around the enterprise, the IQGEO software, the OSPI product goes in. It's very, very services light. There's very little services related to that. So this is where I'm going to answer that question, because our services, we keep a track of the utilization rates of our professional services staff, and they're generally very well. Utilization rates are generally very high. It's around the, I would say, 75 to 80% mark on average throughout the year, which is I think is very good. If you go higher than that, you start to burn staff out. So we've got to be really careful we don't increase it too much. That said, we have got really good visibility of our services. We've got about just under £4 million worth of services backlog into 2022. So I think we will see that revenue we'll be looking to increase our services revenue in 22, probably around the £7 million mark. And we don't only use our own staff, but we also use third-party contractors who we sort of contract with on a short-term or long-term basis. So we've got the ability to work through the backlog of services work that we have. And we've got service partners in South Korea, in Germany, in North America. So quite widespread. So perpetual software and services make up our non-recurring revenues, which are up by 71% to 7.1 million. And then that combined with our recurring revenues make our own product revenues, which is up by 75% to £12.9 million. We then have this sort of third-party services line, which continues to decline. It's declined by 45% from 2020 to £1 million. And we expect that to decrease further as we go, into 2022 and beyond. But again, we thought it would decrease quicker, and it's actually not, is it? It's sort of still remaining reasonably resilient. So again, that's not too bad a thing. So overall, revenues of 13.9 million, up from 9.2 million in the prior year. Just in terms of cash flow, as I said, at the sort of operating cash flow prior to working capital, we're still cash flow negative, but it's significantly reduced from 2.8 million in 2020 to 0.9 million in 2021. We sell most of our subscriptions annually in advance, so therefore we have a positive, contributes largely to the positive working capital movement there of 0.6 million, which is comparable to 2020. And we still, because we're loss making, we do R&D tax credit. We have R&D tax credits in the UK, which instead of reducing our tax or increasing our tax losses, actually give us cash back. So that accounts for £1 million in 2021, and they're not forecast, but I expect to receive further cash back as we do further R&D claims in 2022. We've increased the development of our products, so the amount we're spending on our development has increased from 1.5 million to £2 million, so 33% increase year on year. And then, as I mentioned earlier, there's the 2.5 million we received from the RTLS disposal. We received that cash in January, although the transaction was concluded in December 2020. There was 0.6 million going out for the deferred consideration of OSPI. And there's further, there's the OSPI owners had an earn-out, which was based on them maintaining their levels of recurring revenue in the business from when we bought it. They've easily achieved that, and therefore there will be a further cash outflow in the start of 2022. So we end up with 11.5 million of cash on our balance sheet, which is a good, war chest and gives us a really good buffer as we go forwards. Okay, just looking at our balance sheet at a high level, see there the intangible assets. We continue to capitalize R&D offset by the amortization, so that's 10.7 million. Trade and other receivables continue to grow as the number of customers grows, and it depends on the timing of deals. We signed a fairly large license, 700,000 at the back end of the year, and that hadn't been received, so that's been received now. Trade and other payables includes our deferred revenue balances, and of course, as we continue to grow our subscription, with most of our customers paying annually in advance or half yearly in advance, we expect the deferred consideration to continue to grow as well. And then there's the deferred and contingent consideration, which is, as I mentioned, is for the OSPI acquisition. So overall, ended up with 17.2 million pounds of net assets as at the 31st of December 2021. Just a quick snapshot of our headcount, split by sort of overall roles and geographies as well. So you can see, the biggest number of people we've got, the staff we've got, is in North America, 74, followed by the UK, and then we've got small presences in Europe and Asia. But in those regions we work with a lot of partners. So in Japan, which is our second largest market, we partner with NEC. We bring a large number of their own staff to help us on any professional services work and integrations. And as I said earlier, we will continue to grow that headcount. So I'm expecting, when we report in 2022, we will have circa, if things go to plan, we'll have circa 140 employees. Okay, I think we're back to the some market slides which we've already gone through. So I think if it's questions, if anybody has any.
Yeah.
Thank you very much indeed, Richard Hayward. Thank you very much indeed for the presentation, and also for picking up the questions as we went through the meeting. As Hayward has said, if there are any further questions from attendees, do please submit them now. Just click on that Q&A tab, scroll to the bottom and type your question and press send. And of course, the company will review all questions submitted today and we'll publish responses on the Investor Meet Company platform. I would also like to remind investors that recording this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Just looking to see if we do have any further questions that come through. And of course, you will be able to review those post-event as well, guys. But if we don't have any further questions that are coming through, Richard, perhaps before redirecting investors to provide you with some feedback, which I know is particularly important to you and the team, could I just please ask you for some closing comments?
Absolutely. So, I often describe to my staff, the opportunity we have as being, the right product in the right place at the right time. So, in terms of, the market, we are seeing once in a generation spending, both in telco and utilities, and these are long-term growth trends. The competition, the incumbents really haven't got their act together in terms of the needs of their customers, in terms of mobility, the ability to do SaaS and have an integrated product. We are the only player out there that has such an integrated offering. In terms of being at the right place, well, the key markets we serve are places we've had teams and staff for quite a few years now. So it's all coming together really well for us. And I think these recent wins we've had with systems of record and brightspeed and also PGE, really point to the fact that we're making the right decisions in terms of our product direction. We are listening to the market really well and reacting well to that, and we're offering a really fresh and exciting alternative for these companies in terms of how they run their business in the future. So we head into 2022 with really quite a lot of visibility in our business, and B, a lot of optimism. And what we see here is we see the opportunity to create a business with a very high degree of recurring revenue, very sort of high quality long-term relationships with our customers that will last probably decades. And I think this will make for a very attractive business and a very attractive investment.
Richard, thank you. Richard Hayward, thank you indeed for updating investors today. Can I please ask investors not to close the session? It should be automatically redirected to provide your feedback in order the management team better understand your views and expectations. This will only take a few moments to complete, and I'm sure is greatly valued by the company. On behalf of the management team of IQGEO Group PLC, we'd like to thank you for attending today's presentation. That concludes today's session. Thank you and good afternoon to you all.
Thank you.